For more than a decade, money was unusually cheap. Governments borrowed heavily. Companies expanded aggressively. Investors chased returns. Asset prices climbed. Low interest rates became the foundation of modern financial markets. Then something changed. Inflation returned. Central banks responded by raising rates at the fastest pace in decades. Suddenly, a system built around cheap borrowing had to operate under entirely different conditions. Businesses faced higher financing costs. Governments paid more to refinance debt. Investors reassessed valuations. Markets that had adapted to one environment were forced into another. This is the story of cheap money, how it reshaped the global economy, why it ended, and why its disappearance may be one of the most important financial events of the 21st century. Interest rates influence the cost of borrowing throughout the economy. Following the global financial crisis of 2008, central banks lowered rates dramatically to support growth and stabilize financial systems. In many countries, rates remained near zero for years. Some central banks even adopted negative rates. The objective was clear: encourage borrowing, investment, and economic activity. Lower financing costs made mortgages more affordable, reduced corporate borrowing expenses, and supported government spending. At the same time, investors searching for yield moved into riskier assets. This environment became known as the era of cheap money. What initially appeared temporary gradually became normal. Businesses, governments, and markets adjusted their behavior around the assumption that borrowing costs would remain low for an extended period. That assumption shaped the next decade of finance. Cheap money promised recovery and growth. Lower interest rates encouraged spending during periods of economic weakness. Households could borrow more easily, companies could finance expansion, governments could support economic activity without facing large financing costs. Financial markets benefited as well. Lower rates increased the present value of future earnings, supporting higher equity valuations. Real estate markets expanded as mortgage affordability improved. The broader promise was stability. If economic growth slowed, central banks could lower rates. If markets became stressed, liquidity could be provided. Participants gradually developed confidence that low borrowing costs would remain available when needed. This expectation influenced investment decisions across the economy. The promise was not simply cheap debt. It was a financial environment where leverage appeared manageable and liquidity appeared abundant. The rise of cheap money transformed financial behavior globally. Governments increased debt issuance because financing costs remained low. Corporations refinanced obligations and borrowed to fund acquisitions, share buybacks, and expansion projects. Investors moved further along the risk spectrum, searching for yield. Private credit expanded. Commercial real estate valuations increased. Technology companies attracted enormous capital inflows. The environment rewarded duration and leverage. Assets whose value depended on future growth benefited particularly from lower discount rates. Over time, entire sectors adapted to cheap financing conditions. Business models assumed access to low-cost capital. Governments built budgets around manageable interest expenses. Financial markets became increasingly dependent on abundant liquidity. The rise of cheap money was not driven by speculation alone. It reflected policy choices designed to support recovery and growth. But prolonged success created dependency. The failure of cheap money emerged through inflation. As economic activity recovered and supply constraints intensified, price pressures increased globally. Central banks faced a dilemma. Maintaining low rates risked allowing inflation to accelerate further. Raising rates threatened systems that had adapted to cheap financing. Eventually, policy shifted. Interest rates increased rapidly. This adjustment affected nearly every part of the economy. Mortgage payments rose. Corporate refinancing became more expensive. Government debt servicing costs increased. Asset valuations adjusted as investors reassessed future cash flows. The challenge was not that higher rates were inherently harmful. The challenge was that financial systems had become optimized for lower rates. Years of cheap money encouraged leverage. Leverage performs well when financing costs remain low. It becomes more difficult to sustain when those costs increase. The transition therefore exposed vulnerabilities that had accumulated during the previous decade. Commercial real estate, private credit, government debt markets, and regional banks all experienced pressure, linked directly or indirectly to changing borrowing costs. The system did not break because rates rose. It struggled because assumptions built during one environment collided with another. The collapse of cheap money is not a single event. It is an adjustment process. Markets reprice assets. Institutions reduce leverage. Borrowers adapt to higher financing costs. Some business models become less viable. Some investments become less attractive. The transition can take years rather than months. Its effects emerge gradually through slower growth, tighter credit conditions, and shifting capital allocation. The era ends not with panic, but with adaptation. After periods of adjustment, financial systems establish new expectations. Investors adapt to higher yields. Borrowers restructure obligations. Markets discover new equilibrium levels. The economy continues functioning, but the assumptions that define the previous era no longer apply. Cheap money changes behavior. Its disappearance changes behavior again. The era of cheap money shaped an entire generation of financial decision-making. It influenced how governments borrowed, how corporations expanded, and how investors valued risk. Its success made it appear normal. Its disappearance revealed how dependent many systems had become on low borrowing costs. The end of cheap money is not simply a monetary policy story. It is a story about adaptation. Modern finance was built around one set of assumptions. Now it must operate under another, and transitions are rarely painless.